Welcome to the Chinchilla Picking Podcast, where I'm by myself right now. Sorry, excuse me. I'm by myself. Dave was on vacation. He's back home now, so me and him are actually going to do a full episode tomorrow. But let me get the microphone closer to me. Man, I am a wreck without Dave. Jeez. My computer, I was supposed to put this episode out last week, okay? But my computer had problems, and it was major, and every day I came home, I thought I was going to be able to get this computer to work. Finally today, Monday, an entire week after I was trying to get this thing out, I think I was trying to put it out Tuesday last week. So 6 days later, I finally got this thing up and going. You don't understand what a labor of love I have here for you in this podcast. You guys don't understand. I hope you appreciate it, and I hope you enjoy it, okay? And I hope a lot of people listen to it, and I hope you all hit the subscribe button, because this was a lot of work for me. A lot of work. But it's worth it. It's worth it, okay? So let's get into it, because Netflix had a terrible quarter. It was awful, all right? Netflix, which produces Virgin River, you didn't expect me to go there, did you? You expected me to say, I don't know, You or Stranger Things. You didn't think I was a romantic at heart, did you? You didn't think that. Well, you're wrong. Actually, no, you're so right. The only reason I know about Virgin River is because my girlfriend watches it. I would have no idea that show even existed if it wasn't for her. Anyways, Netflix, they lost 200,000 subscribers. This was their first subscriber loss in more than a decade. They were expected to add 2.5 million. So pretty large gap there between what was expected and what actually happened. And now they expect to lose another 2 million subscribers this quarter. So Bill Ackman sold all of his Netflix stock for a $430 million loss on the tail end of this announcement. This was a $1.1 billion stake that he had in Netflix that he sold. And this helped to tank Netflix by 42% this week. So Ackman actually said here, he said, while Netflix's business is fundamentally simple to understand, in the light of recent events, we have lost confidence in our ability to predict the company's future and to predict their future prospects with a sufficient degree of certainty. So it's just become a little bit more opaque to him. That's why he's jumping out of here. Now Netflix, on their part, they blamed sluggish economic growth, increasing inflation, geopolitical events such as Russia's invasion of Ukraine, which is actually a big deal for them. A lot of companies have been blaming this invasion for abysmal earnings recently, and for a lot of them it makes no sense. But for Russia, or for Netflix here, it actually does make sense, and we'll see why here in a second. And they also said there's some continued disruption from COVID, which that actually makes just a little bit of sense, because, you know, people are home with COVID, they watch Netflix. However, a lot of filming and distribution and all that stuff has been completely disrupted by COVID over the past 2 years. So I kind of give them a pass on that one. So pulling out of Russia actually cost Netflix 700,000 subscribers. Had that not happened, they would have been positive. Not by much, though. Not nearly to the 2.5 million that they were expecting. Even if the Ukraine crisis never happened, they would have only gained 500,000 subscribers. That still would have missed their goal by 1.5 million. So still way off there. Now, CEO Reed Hastings said on the conference call, without going into any specifics, and this set social media on fire a little bit, the company is testing ideas on how to monetize password sharing, like charging people who share their passwords more. So if you've got an aunt or an uncle or a sister or a mom or a brother or whatever you're sharing your Netflix with, at some point in the future, you're going to wind up having to pay a little bit more for that. Another way of monetizing a little bit more for them would be to offer lower prices with advertising. And Hastings said this on the conference call too. Think of us as quite open to offering even lower prices with advertising. This would compete with Hulu, and there's been some other streaming organizations that have offered lower tier pricing that have commercials, and or you can pay up to not have the commercials, whatever. There's more competition in the streaming wars now. The industry is now mature. We've seen this multiple times over the course of stock market history. When an industry becomes mature, oftentimes the value that is lost is more than what's gained. So Disney Plus is now one of Netflix's biggest customer bases. They have 130 million subscribers. Netflix has 220 million subscribers, so they're still the leader here. But Disney Plus hopes to have between 230 and 260 million by the fall of 2024. So they may actually wind up overtaking Netflix if they hit their goal. Now, will that happen? I don't know. We'll see. We'll see what will happen. What we do know is the streaming space is now crowded. This is a highly competitive space now. For the future, there are no clear winners here. Netflix used to be it, and I would still probably put my money on Netflix to win, but I'm not as certain anymore, and I'm not certain enough to buy Netflix even here. Let's talk about how they cancel shows so abruptly, okay? Because Santa Clarita Diet should not be off the air. It shouldn't have happened. Still a great show. Drew Barrymore was great in it. Hilarious. Funny show, okay? Archive 81. This was actually on the rankings of the top 10 shows in the United States. Now, it actually hit number 1. It hit number 1 briefly. It was canceled right after it hit number 1. What sense does that make? That was a tangent. I apologize. So I want to talk about why I'm not buying Netflix right now. And it's not because they canceled Santa Clarita Diet, even though that sours me on the company completely. Netflix is currently trading with a PE ratio of 19.8. Price to sales ratio is not super high, but it's not really low either. It's at a 3.3. Maybe I'd enter around 185, give or take a few bucks, but I'm still iffy on this. We have plunged through multi-year price support levels, and all bets are kind of off. Unlike I was and still am with meta platforms, I'm not itching to get in. I don't see much more room to continue the kind of growth that it's had over the past 12 years. Meta, or Facebook, can transition, and it's transitioning into Meta, and it's doing it with the Oculus and all that. Netflix is making barely any transformations. There's been rumors about a gaming service for years. It's came to fruition a little bit, but more in the mobile-style gaming that, I don't really care about. I know a lot of people pay for the games on the mobile phone and all that stuff. The thing is, with Netflix, though, there's not going to be any in-app purchases with their mobile games. So I don't see that as being a big opportunity. I don't see that at all. Now, I could sit here and say, maybe we can make up some reasons as to what Netflix might do. They may be part of the metaverse, but these are all things that I'm just making up, and that's not a reason to buy a stock, okay? Hey, maybe they'll even buy up some of those idiot AMC theaters. Have to take shots at the meme stock crowd. I have to. Every show that goes by, I have to take a shot at the meme stock crowd. I think I'm going to shut up after the show about meme stocks. But anyways, back on the subject. What they could do and what they are doing are two different things until they announce it or until you get some sort of news otherwise. I don't invest in maybes that don't have grounding in current reality. Now, if they make a heavier push into streaming games that somehow competes with the PlayStation 5's online service and with the Microsoft Xbox online service, then fine. But that's still, in itself, that's still now a crowded and highly competitive industry with two behemoths, Microsoft and PlayStation, already having a leg up on them. So I don't even think they'll try to compete there. The mobile gaming streaming service, it's just, to me, that's disappointing. So I'm not bearish at the current price around $214, which is where it was at when I was writing the show. I'm not bullish either. There are just too many other companies right now that are getting beaten down and don't deserve it. Netflix deserved it. Meta's getting pulled down right now again, along with Netflix, because it lives in the same FANG ETFs as Netflix does. And Meta is now for a second time retesting multi-year lows that I hope become a double bottom. And I would put my money in right now if I didn't already own the stock. If this is a double bottom, I think it'll be fine. This is going to be a tough year for a lot of stocks. A lot of stocks are losing money at the rate where they're giving up all their gains for years. And I think that's going to continue to happen this year. And so what you have to do is you have to buy stocks that you think are of a great value, and using whatever strategy you use. And you just you kind of have to hold them. You got to get through this. You got to get through this year. And after this year, I think the grass gets a little bit greener. The tunnel, the light at the end of the tunnel gets a little bit wider. So the Federal Reserve's problem with inflation, it just makes this with a new atmosphere. This is unlike much of anything most investors in this market have ever experienced, including me. Netflix's free fall isn't the same, I don't think, as its past free falls. This has as much to do now with market revaluing stocks because of rising interest rates as it does with the streaming industry becoming saturated. I don't, and I could be wrong. I could absolutely be wrong. The coming weeks will tell me. But this is a market that it's very hard to buy the dips because everybody keeps selling the relief rallies. And I think this is a trend that's going to happen through this year. I will not be surprised at all if the S&P 500 winds up negative. No surprise. I mean, the Federal Reserve's raising rates probably every month this year from here on out, probably 7 times. And that is just not an easy market to get through. It takes courage to invest in this market, to put more money to work. It takes intuitiveness and patience and a willingness to spend the time and investigating to win in this kind of market. Now, one of the reasons here, because even if you're saying, I don't want Netflix PEs too high, I don't want Facebook or Meta PEs too high. I want a price to earnings below 10. I want a price to sales below 1. I want a price to book below 1. Even if you're using those metrics, which they're great metrics, but these things alone will not tell you the whole story in this market because a lot of them at this point in time are skewed. You should use them. They are still useful, but if you're looking at a company that has a low price to earnings ratio, you better be investigating to see if they were beneficiaries of COVID and stimulus. Were they one of the retail stores that were allowed to stay open in 2020? Did they benefit uncharacteristically from the stimulus checks, an environment that was created by COVID and lasted throughout all of last year? If so, their price to sales will be low because their sales for the trailing 12 months will be uncharacteristically high. Same with price to earnings ratio. It will be low because their earnings will be uncharacteristically high. And if you're not careful here, you could easily be buying into peak earnings, which is a terrible position to be in as an investor. I told you this would be a tough environment and that it would be harder to make money. And I told you that you would have to be picky. Now, there's some ways that this crazy market, this new machinery, go back to January, I had an episode on this, the new machinery of the market. I told you this was different. I said it. I did not know a lot of the ways in which this new market and this new environment and the revaluation of stocks would manifest itself. Quite frankly, I probably would have put money on GameStop and those meme stocks being below $10 right now. Looking back and investigating the .com bubble, that could take years. And I'm sorry, if you're investing in GameStop, you think it's going to make you a millionaire and you're still holding on to it, you're delusional and you're fooling yourself. And I know those are strong words, but you have to sell. You have to get out, okay? If you're one of the people day trading this thing, fine, have fun. Have fun doing it. But over the long haul, these things are going to crash and burn. I have never been more sure about anything in my entire life, and I'm not going to do a show on it because I'm bored with it, okay? This is probably the most amount of time in the coming weeks, unless somebody forces me to, unless we have another short squeeze on GME or GameStop or whatever. Maybe I'll do another show on it then, but I'm so bored with the meme stock thing. So let's end it right now. I don't know when it's going to happen, but they're going to crash. It's going to happen at some point. I don't know when, okay? All right, let's get back to the subject. The price to earnings, price to book value, price to sales, all that stuff's not telling you the whole story now. And I want to give an example. Foot Locker. I briefly mentioned it on the show last week because it came up on a screener, and I didn't expect to see it on the screener, but it showed up there on a value screen. The price to sales is below 1. The price to earnings is at 3.37. That sounds like it's at a terrific value. But let's think about this for a second. What did a lot of people do with their stimulus checks? They went out and they bought sneakers, shoes, Nikes, Reeboks, whatever the popular brand is. I'm not really into clothes. I know Nike's really popular just from the stock market, but that's what they went out and bought. And Foot Locker was a big beneficiary of that. Now, what was a tailwind, the COVID spending, the stimulus, all that stuff was a big tailwind because of comparables and how people value their stocks. It's now a headwind, right? Comparables are going to be really tough for Foot Locker this year, especially when they're expecting a 4 to 5% drop in gross margin. And they're expecting a decline in revenue this year. Because last year and late 2020 were abnormal. Their price to earnings at 3.37 is going to look a lot different at the end of this year. Now, usually when you see an increase in price to earnings, that's because the price of the stock has went up. In this situation, it's likely to be that the earnings have dropped. So you have a lot going against you when it comes to Foot Locker, okay? You've got declining earnings. You've got tough comparables because last year was so good for them, and this year's not going to be as good. In fact, it might be a bad year because everybody's grocery prices are going up, gas prices are going up. The more money people spend on the necessities, the consumer staples in their life, the less money they have to go and buy the new Jordans. Now, speaking of the new Jordans, really the new Nike here, speaking of new Nike shoes, Nike's backing off of Foot Locker. They're going direct to consumer. So, Foot Locker's still going to sell Nike. They're just not going to sell as much of it. And that's their number one brand. So that's another headwind for them too. So when it comes to all this, industry-wise, I think I just want to stick with the insurance industry. There's so many value stocks here. There's so many great stocks in the insurance industry. They didn't really benefit from stimulus checks. Nobody went out and said, I think I'm going to buy more Geico with my stimmy. I'm going to get some gold-plated AIG rims. No, that didn't happen. It didn't happen, right? So if you're looking at value in the insurance industry, and you really have to separate the financials from the insurance industry, because I'm not trying to get trapped in a situation where I get hurt really bad because of another yield curve inversion. So investment services and all the stuff I'm kind of staying away from right now. But I do like AIG. And I liked AIG in the past. I traded it, and I'm thinking about getting back into it. It was down again today. I like it under $60. I like it even better if I can get it around 57. That's one of the points I'm looking at right now, because on a day-to-day basis, the technical chart just passed below the Keltner and the Bollinger Bands, and I'm thinking this thing might actually go to 57 before it bottoms, but we'll see. Anyways, you could still put some money to work now. Like I told Dave before, maybe you do 30% now or 20% later if you get another decline here. AIG's price to sales is 0.94, so 94 cents to $1. You're getting a discount to their sales. You're getting a discount to their book value because it's 76 cents book value here. So 76 to $1. Price to book is set 0.76. Let me just be clear about that. I'm kind of rambling. Price to earnings is 5.57. I think it's a deal. I like this. People didn't go out and spend their $2,000, $3,000, whatever they got on new insurance goodies. It's just not that exciting. So that's where I'm at right now with this market, and I really think that you really, if you're going to go and buy stocks, and I'm not going to tell you to not do it. Obviously, I'm doing it. I'm just being more picky, right? I'm really looking at price to sales at max 1.5. At max. And I'm really looking at price to book at 1 or lower, and my price to earnings has to be below 10. For what I'm buying right now. Now, Metaverse, I don't think that meets any of those categories, but for a tech stock, it's still a great value. So I'm still in Meta, just so you know. Okay, I'm not leaving it, but for what I'm buying now, that's my standard. Those are my standards of what I'm looking at. So just to let you know. All right, that's all I've got for today. We will have a full show with me and Dave tomorrow. I hope that I've been educational, uplifting, exciting. You would really think I would know that introduction by now of my own show. The show that me and Dave have done for over a year, you would think I would know it. But, you know, when Dave leaves, he goes to town, my computer breaks down, podcast burns down. Dave, never go on vacation. You're not allowed, okay? All right, have a good night.